Hi, good morning, good afternoon, depending on where you are. Bigger Pockets community, Cushman here, back to answer in all questions on syndication and apartments and multifamily. Hope you are all doing well and slowly getting back to normal life. At least we are kind of here in California. I think that's the case most other places. For those of you who don't know who I am, I won't give you the full story. I used to be a chemical engineer, went into flipping houses in Southern California, and then realized that kind of felt like a job too. So went and learned multifamily and syndicated a 92 unit apartment complex back in 2011. And that's part of what gave me a lot of my gray hair. It's pretty stressful, but it was one of the best things we ever did. We went into that full time. We've done about 1,800 units since. My BP episodes, I think, are 170 and 279 if you want more of the backstory. But I'm not here to tell you my story. I'm here to answer questions. So one thing that comes up very commonly is, kind of what's happening out there in the market with all the coronavirus and the shutdowns and the stimulus. And, what are we seeing in the multifamily market? And, partially, one, it's definitely local. Some markets are feeling this in different ways than others. But in general, collections are actually really, really good. When this hit, we were really concerned of, oh my gosh, is 70% of the people can't go to work. How do you run an apartment complex and only 30% of your residents can pay? Fortunately, none of that actually happened. The stimulus checks came in. Unemployment benefits are really helping, especially kind of in the workforce segment. We have people who are making more money staying at home in their apartment on unemployment than they did at their job. And so the net effect of that is April collections were basically right in line where they should have been. And May is trending higher than April. People are taking the extra money and getting caught up. So people that were a little behind before this started are using this as an opportunity to get caught up and no longer be behind, which is actually, it's great to see that people are using the extra money on balance responsibly and shoring up their finances. So far, things are going really well. Going forward, we expect June to probably be pretty strong too. July should be okay. And of course, all this is assuming no major shifts in the current trajectory. This is kind of assuming things do, slowly continue to open up and don't get worse. And we're actually more concerned with what does fall and winter look like when all this extra unemployment is gone. Perhaps we're in a situation where we have long-term unemployment or unemployment has gone back down to the normal levels. And, we're kind of just into a more normal recession. But the wild card is we never know what the Fed or Congress is going to do to try to keep shoring things up. So that's kind of where we are today. We'll get to some questions here, and I want to thank those of you who posted in advance on Instagram and on Facebook yesterday. So we're going to start with a couple of those questions. Then we'll get to the live questions. And when you're posting your questions, don't forget to let us know where you're coming in from, and hit the like button and share, and let us know how we're doing. So all right, let's see, from Instagram yesterday, at s.vun, where do you find partners for syndications? Well, the first place would be Bigger Pockets. The Bigger Pockets community is full of people who are going to help round out your team. And you said partners for syndications. The question didn't specify if you're talking about someone to find deals or someone to raise money or someone to be boots on the ground or someone with management. There's lots of different partners. But assuming that you are talking about like a general partner who can help with anything in the business of buying and syndicating apartments, Bigger Pockets is a great place because if someone's on Bigger Pockets, they're already interested and engaged in real estate, and you can just go to the multifamily forums and discussions and go to the lives and Facebook and just connect with people who are interested in, and you will find partners. Meetups, of course. And then some of the courses that are out there. I know people who go to the courses not to sit and listen to whatever's being spoken about, but they're actually there just to network and meet partners. I've actually met some of one of my largest investors was somebody that I just met at a local meetup right here in Southern California. Very high net worth individual, was interested in real estate, and she's been a great investor. And so you can, and she is somebody who has enough capital where she could be, if we wanted to, just a full-on partner. So that's really the best way, is just network, talk to people, meet people, get out there and just talk about it. It's in that sense, it's simple. But I would say it's kind of having a partner. It's a lot like marriage, where it's easy to get into, but not necessarily easy to get out of. And so you want to make sure you choose wisely going in. Somebody that not only has the skills or the finances or the balance sheet or the reputation, or whatever you're looking for, but somebody that you're going to enjoy working with, somebody that you feel is a person of high integrity, and that is not going to do anything to ruin your business or your reputation. Because if they do something and you're partnered with them, then that's basically the same as you doing it as well. So good question. So, hey, Tony Peters just says, I'll be back. Laura Snow, hello. Ricardo, hello. Kelly Andrews, thank you. Celeste from Florida, good to have you on. And please keep posting the questions. So let's see. Let's do Alley 24. How does raising private money work for residential multifamily? I'm guessing by the question that means residential being 4 units and under, because typically once you get to 5 units and up, then that's kind of, that's where you're looking at commercial loans, and anything that's a fourplex on downward, that is a residential loan. So I'm going to assume that's what's meant there. Generally speaking, a fourplex or under is at a price point where a true syndication may not financially make sense, right? Because hiring an attorney to do the PPM and the operating agreement and just all the legal work, that's typically starts at about $10,000. So if you're, and when you're buying a $10 million apartment complex, that's a relatively small piece of the total expenses. But it may not make sense if you're buying a $200,000 fourplex. So generally, the easiest way to raise private money for residential multifamily, or the smaller stuff, number one is to see if you can find one person who can do the entire loan, or just actually do debt. You can do so instead of saying, hey, you're coming in for $200,000 of equity, say, hey, I'm going to give you a note that pays 7 or 8 or whatever percent every month or quarterly, and we're going to secure that against the property. Whenever I did my my single family stuff, that's how it was done. It was just individual investors, and they had a secured note. So that way we don't have to pay an attorney for syndication documents. And if it's one investor, it's not a syndication. Now, if you do need to bring in multiple people, there's still a couple different ways to do it. Candidly, a lot of people will just say, okay, I'm going to do 3 or 4 notes. So let's say you need $400,000. You have 4 investors who'll each give you $100,000. You can give them 4 notes. You can record them. There's a term called pari passu, which basically means they're on equal footing. So it's not like a first loan, second loan, third, fourth. They're just all equal. And those investors can come in and each put in $100,000, and you can raise the money that way. Some attorneys will say, technically that is a syndication because you've kind of broken it up into 4 pieces, and technically that is a security. So I would at least check with an attorney before you do that. The other way, though, is you can joint venture with those people, right? And if you're all managers or equal in the owning or managing entity, and you all have a role in participation, then that's just a JV or a partnership, and you don't have to worry about syndication that way. So that's a really good question. Again, the biggest thing is it depends on, again, the size, right? The financial size. If you're buying a fourplex in San Francisco, it actually could make perfectly good sense to spend $10,000 on a syndication, because that's going to be probably a $1 or $2 million purchase price, or possibly higher. I don't invest in that market, but I know it's crazy expensive. So good question. All right, Justin from St. Louis, thanks for reaching out. Appreciate you saying hi, and longevity to you all. I agree. That sounds great. Ricardo, hello. I'm from Hollywood, Florida. Thanks for specifying. My question is, when looking to invest in a syndication, what due diligence should I be doing to minimize the risk of not getting paid? Excellent question. We hear a lot about how do you do due diligence on properties and markets and all of that. But if you're investing passively, it's probably the most important due diligence that you can do is on the person that you're investing with, because a good sponsor can turn a bad deal good, but a bad sponsor can turn a great deal bad. And when you're investing passively, yeah, there's the deal or the fund or the market, but what you are truly betting on, or your biggest bet, is the person that you're investing with, the person that is running the show. So number one is to get them, is to try to get them on the phone, get a real conversation with them, and ask questions that are, the usual basic stuff of, how many deals have you done, what markets, how do you choose markets, how do you underwrite now, and if you're looking at a specific deal, you can ask things like, okay, well, what kind of rent growth assumptions did you put in? What happens if, how did you stress test this deal? So what happens if occupancy drops 10 or 15%, which is a possibility in the next couple of years? What happens if rent drops 10%? I recently saw, I think it was Green Street projected 8% rent decline in the next year. So all those kind of questions. But then some of the really key questions is, I would always ask somebody, tell me about the worst deal you ever did, and how did you handle it, and what was the results, and really dig into that, because that's going to tell you more than, if someone's got, number one, if someone has significant experience in multifamily, they're going to have had deals that didn't go to plan. That's just the way it works. Hopefully most of them did plan or better, but there's going to be some that don't. And actually, and even some of the ones that maybe beat pro forma, there's going to have been challenges there that weren't anticipated. So what I found is some of the most revealing questions is, what is the worst or most difficult deal you've ever had? What are the results of that? Did investors lose money? Did you have to put in capital? And that's actually another question you could ask is, tell me about a time where you've had you needed more capital than was available. How did you get that capital? Really dig down onto those kind of things, and then also ask for investor references. Say, can you give me a few names and contacts of people who have invested with you for a long period of time, and then talk to those people. And then my favorite is, when you're talking to those investors, ask them, say, do you know anybody else who is invested with so-and-so that I can talk to, and get a secondary reference, right? Because Ricardo, if you ask me, hey, Andrew, can I talk to some of your past investors? I'm going to say, sure, here's a long list. You can pick from them, right? But if I had an investor that hated me, I'm probably not going to put that person on the list, right? So if you, and by the way, if you do talk to a reference and they're like, yeah, this guy's not so great, number one, that's probably a sign you may not want to invest. And two, it's odd that they couldn't find anybody that would give them a glowing review or has had a good history with them. But if you get a secondary person, a referral from the first referral, that is a truly candid reference. So that's some of the stuff, how I would go about doing that. And that is super, super important, because again, you're really betting on the person, not the project. So good question, Ricardo. Appreciate it. Let's see. We've got quite a few questions here. Vicky, hello from expensive Southern California. I feel your pain. SoCal is great for flipping, but yeah, if you're looking for cash flow, very difficult market. lots of political and legislative risk as well. You never know when they're going to come out and say, in the last couple of months, we've seen things about statewide, cut rents 25%, 12-month moratorium on rental payments, let the landlord figure it out themselves, all kinds of crazy stuff. So not only is it expensive here, you've got some political and legislative risks. So I stay here and enjoy the weather and the beaches and the mountains, but invest in areas that are more landlord friendly or balanced. And also we get good cash flow. So glad to hear you're learning from the videos. Appreciate it. And yeah, hit the like button. Let everyone else know how we're doing. Let's see. So Doug, how can I secure a deal from a seller who is shying away from selling during our current state? The short answer is you can't. However, and then that's something to always keep in mind when negotiating these. Oh, hey, I like your Red Sox logo. I'm guessing you're maybe from Boston. Let us know. But number one, that's something to always keep in mind with negotiating with really anyone, but also specifically sellers of multifamily is. You can't. You can only control what you do in your actions, right? So if a person has a certain mindset or a certain approach, you can certainly influence that, but you can't control it. But some of the things I would do, and actually just had some experience with this. We were under contract with a property that we got under contract before COVID-19 hit. And then the seller had some legal issues that he had to clean up. So we put it on pause. And then COVID-19 showed up in the middle of that. And so we just extended it about 6 weeks. Then we got to the end of the 6 weeks. And this was just last week, actually. And the seller, he said he didn't want to extend anymore. And he also, didn't want to make any pricing adjustments or anything. And we said, well, hey, your occupancy is down. Your collections are down. It looks like we're probably headed into a recession, and the lending options are now terrible, right? All the bridge lenders went away. Well, almost all the bridge lenders went away. It's really difficult to get financing. And so, we tried quite a few different approaches. We said, hey, look, we can give you, this price if you'll do some seller financing. We can give you this price if we'll buy it cash. We can give you a price in the middle if we need to go out and get a loan. So one way I would try to secure the deal is to try to give them options. And then maybe even before that is to really try to dig into their mindset, right? And try to figure out why are they shying away from selling during our current state. So if they're shying away because they're worried about, physical interactions and actually getting coronavirus, then let's say, hey, we can figure out ways to do this virtually, right? We can, we'll go in, look at vacant units, and then for occupied units, we can, have someone walk through with a Facebook Live or something like that. We can do mobile notaries. I mean, when we do closings now, everything is virtual. I haven't actually been to the closing since I think 2011. So finally, I guess, so is it that? Are they thinking, hey, you know what? I'm just going to wait and get higher prices next year? I would maybe try to help them understand that that's probably not likely. Well, I don't personally think we're going to have a complete crash like the last time, but at the same time, it looks more than likely that pricing will at least dip for the short term. So do they really want to hold on for a long time? So that's what I would get into is what is holding them back, and then try to provide options for solving that. So good question. All right. Let's see. We got all right, John Segara. Why are banks not offering HELOCs on non-owner occupied 1 to 4 family properties? Well, the simple answer is they're nervous. The banks largely learned their lesson in the last the last recession from 2008 and 2009. And one of the things they saw is that when it came to rental properties and investment properties, lots of people very easily just let them go. So, all right, well, I can't make the payment. Tenant moved out. Oh, well, here you have it back, right? So the banks are looking at that saying, well, we're not going to, we're already in an uncertain environment, and we're not sure what the future looks like. Last time we got burned really badly on these type of properties, so we're not going to lend any further on that. And I actually just saw it. Emily, thank you for asking. Would you mind explaining what a HELOC is? That stands for home equity line of credit, right? So let's say you've got a fourplex that's worth $400,000. You only owe $200,000 on it, and you want to pull some of that money out, but for various reasons, maybe you don't want to do a full refinance. So you go to the bank and say, hey, I'd like to get a $100,000 line of credit on this property. And so the benefit of the line of credit is you don't have to pay interest on it until you use it, right? So let's say you go to the bank, you get that line of credit for $100,000, and you go to closing, you sign it. Great. Well, the money is still at the bank. And then 3 months later, you find an investment property. You need $50,000 to buy that property. You can write a check, and then what that does is that check pulls from the line of credit, and so now you owe 250 on that property, and then you can go all the way up to that additional 100,000. So the nice thing about a line of credit is it's almost kind of like a credit card, where you can use the money when you want, and then you start paying interest on it, but then you can also pay it back right away, right? There's not a prepayment penalty. So let's say you pull the $50,000, you put it into a single family, you flip it, and then you get the money back. Now you can pay off the line of credit, and now you're not paying interest. And then a month later, you get another deal. You can pull that money again. So it's revolving, which makes it really, really nice. Back to the original question. Banks are just nervous. They're looking at investment properties as much higher risk, and they're trying to cut their risk. Really good question. All right, let me see. Guys, I appreciate all the questions. This is great. Keep letting us know where you are coming in from. Last few times we had people from Israel and Germany, and still haven't gotten anyone from Antarctica yet, but I guess there's probably only 6 people down there anyway, so the odds are low. All right, let's see. Well, lots of good questions. Which one all right, we'll try Craig Herring here. Hello, Craig. All right. My question, are there any new or unique strategies for finding 2 to 100 unit multifamily now or after COVID-19 conditions? You're thinking along the right lines, Craig. Thank you, and would love to meet you in person one day. Yeah, hopefully maybe we can connect at a BP Con or another conference or something like that. So are there any new or unique strategies for finding 20 to 100 unit multifamily? I wouldn't say there's any new strategies, but you're heading in the right direction in that there's one of the things that we have in the real estate world is there's never a bad market, just a bad strategy, right? And so, previously in the last 5 years, you could buy almost anything at a 5 cap or whatever and assume some rent growth, do some value add, and if you did that, it came out pretty well. That's not likely to be the case going further. So as far as finding 20 to 100 unit multifamily, I would go ahead and start shoring up your broker relationships and letting them know that you are out looking. Historically, most properties in the last few years, went off market very quickly. Or if they did get listed, they had 20, 30 offers and went very quickly. So I mean, the basics aren't going to change. It's very much a relationship business. The primary way you're going to find those deals is through brokers. But with that said, especially on some of the smaller properties that are less than 100 units, where you tend to have more mom and pop ownership or non-institutional ownership, where it's really just a guy or a lady or a couple or something that just happens to own the thing, in that smaller sub 100 space, that's the situation where you might be able to reach out and get connected with the owners and put a deal together, just you and them. And brokers, brokers are great. I mean, almost all of our deals. I think everything over 100 units except for one came through brokers. That is our primary way. But generally speaking, if you can, the fewer people involved in negotiation, usually the easier it goes, right? So if you're looking at smaller stuff in the 20, 30, 40, 50 range, number one, work with brokers. Number two is you might consider trying to reach out directly to some of those owners and just feel them out. And maybe even start with, hey, you know what? Right, like if you start those calls this week and be like, hey, now you might not be interested in selling right now, but just wanted to let you know that if you are sometime in the future, I'd be happy. I'm interested in your property, and I'd be happy to have the conversation. And just kind of feel them out, see how they respond. And if you do make that call, research the property a little bit beforehand, right? I get these letters and phone calls all the time where it's like, hey, we saw your property in Atlanta and we're interested in it, and we have a real live buyer. It's like clearly they didn't put a whole lot of effort into it, right? And I'm also like, well, I sold that 8 months ago. So do a little bit of research, know who you're talking to, and know the property. But those are the two main ways. The biggest thing that has really changed for COVID, again, is your assumptions, right? So we don't want to be making a ton of high rent growth assumptions or super high occupancy assumptions. Just be a little bit more careful on that. Assume a little bit lower leverage if you're getting a loan. Seller financing, that actually probably is going to get more popular as lending gets more difficult. So good question. Thanks, Craig. Jerry, hello from Miami. And let me get a sip of coffee here. All right, we're going to grab another one of the Instagram questions. So Luke Salisbury Steak. How do passive investors make a profit? Lots of different ways to do that. But really, the number one way passive investors make a profit is to invest with the right person. But the mechanics of it, you can get paid interest. So if you invested debt as a passive investor, then maybe you're going to get paid, 8% every a year on monthly interest payments. So that's one way that you can make a profit. Another way is investing in syndications, and those can be structured a lot of different ways. But the kind of the standard way and how ours are usually structured is, as a passive investor, you get a portion of the operating profits, right? So if the property makes $100,000 profit in any given year, maybe 75% of that goes to investors. And so if you invested, let's say you put in 10% of the equity, so there's $100,000 profit, 75% goes to investors. So that means 75,000 is going to investors. You put in 10% of the equity, so that means you get $7,500 that year in operations profit, and hopefully that continues year after year after year. Also, as an equity investor, when hopefully there's a significant profit on the property when it is sold, and you should get a portion of that as well. And again, that's just kind of assuming a simple 75-25 split. There's all kinds of different ways to do it, but as a passive investor, you can make either interest, you can make profits from operation, profits from sale. Those are really the main three. And again, the key is picking the right sponsor. So, all right, let's see here. Craig, thank you. Thanks for going deep. I appreciate that. And let me see here. All right. Hopefully we're back here. Okay. All right. Not sure what happened. Everything just kind of disappeared, but seems like we are back online. Looks like it wiped out all the questions. So, all right, here we go. All right. All right. Yes. Thank you, everybody. The broadcast was down. We are now back up, but we lost the question. So anyone who was out there who didn't get your question in, or just had one in the back of your mind, now's the time to go ahead and throw it in there. So please go ahead and do that. Again, let us know where you're from. Hit the like button and give us your feedback. I think the furthest we've gotten away from today is, or furthest distance from where I am today is Miami. We got Victor is from Fresno. Oh, he's just a few hours up the road. And let's see, Tao, I saw you from Minnesota actually, and we didn't get to your question. So let's go back up. All right, here we go. Tao Fang, any tips to how to find and interview the right GCs to do your multifamily updates and turnaround? That is that is super critical. It's one of the key pieces of your team, especially if you're doing value add properties. And I just hear that we are down again. Let's see here. Well, all right, I'm going to keep going because it's showing me that we're going. So any tips how to find and interview the right GCs to do your multifamily updates and turnaround? The primary way is to do referrals. And, so one of the things, if we're buying a property and we've got and we're using a third-party property manager, which is what we do because we like to have that experience and their market knowledge. The first thing we do is ask them for referrals, right? Because hopefully they've been working with contractors for a long period of time in that market, and they know who's reliable, who charges good prices, who is who's honest, who does quality work, because that's definitely another frustration is, you pay someone to turn a unit, and you go in and you look at the work and you're like, okay, we need to redo half this work again. So the number one is really referrals. We start with a property management company, but then also don't forget brokers. A lot of times we'll talk to the brokers and say, hey, do you have any contractors that you like to use? And what's your experience with them? Could you recommend a contact? Other owners, right? So this is another place where bigger pockets can be super helpful. Is say, hey, I'm investing in Atlanta, Georgia, and I'm looking for some good contractors. Do you know any that you could recommend? If you happen to know a public adjuster, they tend to know a lot of really good contractors. And then if you can't, for some reason, you just can't get referrals or can't build a list that way, then I would just go out and find people just on Google and make a list and start interviewing them. Look at the projects they've done, ask for owners to talk to that they've worked for, and go that route. But again, candidly, we've never had to do that except for in the very beginning, right? So we've always been able to work off referrals, and that's the best way to do it. Number one, you're talking to someone who's already had experience with these people, but then at the same time, hopefully the contractor that got referred to you is going to want to make the person who referred them look good, right? So there's a little bit of extra incentive there for them to perform well for you. So great question. That's a big piece of a successful turnaround. Victor Morales, follow-up question. What does preferred return to members mean? What that means is that investors are, to use the term, preferred over the sponsor, meaning they are in first place. So let's say you're looking at a syndication where we'll make simple numbers. It wouldn't normally be this high, but a preferred return of 10% to investors. So what that means is the investors each year, and it could be quarterly, it could be annually, but typically it's annually, investors have to receive a 10% return on their money before the sponsor can get everything, right? So that's basically all that means, is that the investors at our higher level than the sponsor, and the sponsor, has to pay the investor first before they can take any. And that could be preferred return. It could be 6%, 8%. A lot of deals actually don't have a preferred return. And just to clarify, because sometimes you'll hear someone say, "Oh, this has a pref of 10%." That's what that's referring to. It's the same thing. That is actually different than what's called preferred equity. And preferred equity, preferred equity is actually it's kind of like a piece in between a loan and the equity that we were just talking about. Whereas the just general equity, where if you say, "Hey, I'm investing $100,000," most cases you're participating in the upside. Well, there's another chunk called preferred equity, where you get effectively a guaranteed rate of return, maybe 6 or 7 or 8% return, but then you don't participate in the upside, right? So the trade-off is maybe there's not as much profit for you on the back end, but you have to get paid before the regular equity and the sponsor, right? So it's kind of that's a bit of a trade-off, but that is actually different than preferred return. So you have a preferred return, which that just means you get paid before the sponsor, and that's often called a pref. And then there's preferred equity, which means it's a special chunk of the equity that is kind of a higher status than the rest, meaning that they get paid first, but then their upside is limited. So really good questions here. All right. Seems like we're back online. Questions are flowing. Let's see. Let's go with Leslie Morgan. Remember, guys, let us know where you're from. So, do you use private lending to invest in real estate? Absolutely. Private lending is one of my favorite ways to invest in real estate, especially on the smaller stuff. So when we were a flipping business here in California, we did subject to combined with private lending. So what that means is, let's say we were buying something for $400,000. There's a underlying mortgage for $200,000. We would take over that mortgage of $200,000 and just start making the payments. But then there's still $200,000 that we had to give to the seller, right? So we would just go to private individuals that we knew and say, "Hey, we'll pay you this interest rate. We'll put a lien against the property in your name, and pay and use their funds to purchase the properties." And yeah, I mean, we're Southern California, as everyone knows, is a very expensive market. And so when we had 4 or 5 flips going at the time, there's no way we could have financed that ourselves. So we used private money for every deal we did. And then in the multifamily world, the bigger the numbers get, of course, the harder it is to find someone who can say, "Yeah, I'll lend you $1 million or $2 million or whatever." But that's where seller financing, which really is another form of private lending, comes into play. In fact, our very first deal back in 2011 was, like I said, it was 92 units. It was mostly vacant. That was back in a time where it was very hard to raise capital. And we had to pull together a total of $1.2 million. I completely underestimated how hard it was going to be to do that at that time. And plus, that was our first deal, so we didn't have any history. We didn't have a network of investors, and so we were running a little short. And so we went to the seller who owned this free and clear and said, "Hey, will you do a partial note and basically become a private lender?" And he agreed to do that, and that filled the gap, and we were able to get that thing closed. So absolutely, I love private lending. It's usually faster, usually far less red tape. And you know what? If you run into a snag or an issue, it's a person that you can call and talk to, right? As opposed to a bureaucracy or a loan servicer that's servicing X many millions of loans, and every question you have, "Oh, well, that's a different department," and all that kind of stuff. So I love private lending. If you can do it, absolutely go that route. It can make and it's a great return for the person that you're working with too. So it really is a win-win. All right, so Lehigh is from Phoenix. Thank you for joining. Let's see. All right, we got some more questions here. Let me scroll back up just so I don't miss any. All right, Lehigh. Should I refinance? I have a 5% interest rate, have about 35,000 equity in the duplex I'm house hacking at the moment. Need about $10,000 left for 20% in takeaway PMI. Not quite sure about what Lehigh. I'll start answering your question if you maybe clarify about that last part. But if you've got a 5% interest rate, my guess is there probably is a good chance a refinance would benefit you at this point. Mortgage, I just saw, today's Friday. I just saw something yesterday about mortgage rates hitting all-time lows. Now the banks are being a little bit more difficult about investment properties, but if you're house hacking, then I'm assuming that means you live in it. So that would mean it's owner occupied. So yeah, you know what? I can't say for certain that you absolutely should refinance, but you absolutely should look into it. I believe rates on 30-year fixed right now are hovering, right around 3 to 3.25, 3.5%. And obviously it depends on market and then your credit and, income debt ratios, all that kind of stuff. But I would certainly look into it, and then just talk with your mortgage company, talk with your broker about, the pros and cons about, well, if I can stay below 25% and get rid of the PMI. I can say when I bought my very first condo, which was to live in, that was one of the first things I did was get rid of that PMI, because that is not benefiting. That is an expense that doesn't benefit you one bit. That is insurance that you are paying for the lender's benefit. It is essentially, from your point of view, completely wasted money. So I would say if you can get your rate down from 5 to 3, then absolutely, especially if you can get rid of PMI. And if your question is if you need to bring in $10,000 to get rid of that, it still might be worth doing it. What you can calculate is say, all right, if you treat that $10,000 as an investment, right? Okay, we do have a clarification here. So, all right, Lehigh, I put 15% down and need 10,000 left to get to the 20%. Oh, okay, all right, good. That's actually right where I was headed. So, calculate the return. So if by putting in $10,000, you can get rid of the PMI, that is an expense you limit, right? So let's just say, I have no idea what PMI costs these days, but to use round numbers, if PMI is costing you $1,000 and you can eliminate it by putting in $10,000, well, that's a 10% annual return. So that's pretty good, especially in today's market. So it might make sense to do that. So the short answer is just, kind of calculate, well, how much do I save by putting in this 10 grand? And then, that decides whether or not it might make sense to do that. But at 5%, I would definitely call your mortgage broker and see what they can do for you, because that's high nowadays. All right, Pat, hello from New Jersey. All right, thanks for letting us know. Do you have any tips on how to get non-conventional funding without paying high interest rate? By non-conventional, I'm going to assume that you might mean maybe hard money or private money or some of the tougher bridge lenders, perhaps. And that is definitely one of the trade-offs. Is you do end up getting higher interest rates. So, the best way to get non-conventional funding without paying a really high interest rate actually gets back to the question we were talking about a few minutes ago, and that is the private lending, right? So if you can find an individual, maybe they're retired or they've got a retirement account, and they'd be thrilled, to have a steady, 6 or 7% every month coming in. Their money's not in the stock market where it goes up and down huge amounts every day. And they would rather just say, look, I'm like, Pat, I'm going to give this to you. You pay me 6.5%, on monthly payments. I'll be happy. That's really the best way. Now, as far as if you do want to work with a hard money lender or a bridge lender, if you lower the leverage, that tends to help get you a better rate, right? So if you're looking to go for 80% leverage, your rate's probably going to be higher, right? But if you go back and say, well, hey, look, you know what, let's just do 55%, then you might be able to get a better rate. So all terms are negotiable, all terms are adjustable, and that's really the way to do it. So. Okay. Well, hey, I am going to probably just take one or two more questions, and then we'll get wrapping it up after that. So if you're sitting there, have any questions that you've been waiting to get in, or just kind of been thinking of, go ahead and post them now. We'll try to get to them really quickly. And yeah, hit the like button, and let's see what we'll get here. All right. Well, I'm not sure how to pronounce this, Ale, but you posted first, so we'll just jump right on and grab that. For rental purposes, I was advised to build new, a mostly brick, thus long-lasting house to save in repairs long-term, but I don't know if it'll be cost-effective. I'd appreciate your opinion. I will offer the disclaimer that I am not a developer, and I don't do development yet. We actually are looking at getting into that, and this would apply whether you're building a single family or a fourplex or a 10 unit or 100 units. When you're getting a rental property, long-term maintenance costs is something that candidly is overlooked. So first of all, you're thinking about this correctly, right? If you're going to hold something for a long time and you are going to build it or even renovate it, you want to keep in mind the lifespan of the materials, right? So for example, when we're renovating an apartment complex, if we're only going to hold it 3 or 5 years, we might go with laminate countertops. And of course, it depends on the class of the property as well. But we have other properties where we knew we were going to hold it for at least 10 years, so we put in quartz countertops. Yes, that was more expensive up front, but those quartz countertops are almost indestructible. And what we're looking at, say, hey, rather than having to start replacing countertops 3, 4, 5 years in, which is going to get expensive, we're going to spend a little bit more up front and eliminate that cost for a long period of time. My experience with brick buildings is they do tend to be pretty low maintenance. What I like about brick is that you don't have to repaint it every 5 or 6 or 7 years. That is definitely an advantage. And I'd say probably the biggest advantage. I don't know how brick performs as far as heating and cooling expenses goes. Again, this is getting a little outside of my realm because I don't develop. But when I look at the properties I've owned over the last decade or so, the ones that had a brick facade, meaning there's still wood frame behind it, and then they just put brick up on the outside, those were some of our lower maintenance properties because that brick just tends to hold up really, really well. So my guess is yes on the brick. My experience with it has been good, and yeah, that's probably a good way to start. So, all right, we have. I'm going to pull want to make sure we get to our Instagram folks. So Drew Erpenbach, if you were 20 years old like I am, where would you start? Well, you're in the right place. Bigger pockets. I wish I knew this existed. Actually, when I was 23 years old, Josh hadn't started it yet, so it didn't exist. So first of all, 20 years old is an awesome age to get started in this because, I mean, real estate, it's not a get rich. People say it's not get rich quick, and it's because it's not get rich overnight. But if you look at what can be accomplished in 10 years in real estate, to me, that's get rich quick, right? I mean, you can do a lot in 10 years. So start bigger pockets, educate yourself, network like crazy. Don't know what your goals are. I'm assuming it's to buy a lot of real estate and maybe build a real estate business. If you're renting, go house hack, right? Buy a fourplex and live in a unit and rent out the other 3. Get some experience with landlording and with owning a rental, just owning a property. Continue to educate. Find as many experienced partners as you can. And I say that is definitely one of the things that we made a lot of mistakes in the beginning, but one of the things that we did right, and I'm really glad we did, is the minute we decided we wanted to get into apartments, we went out and found someone who had already done at that time about 800 units and hired them as a mentor to accelerate our learning process, help prevent us from making really expensive mistakes. And because the problem with experience is you get it right after you need it. I've said that before, but so you want to find someone else who already has the experience and learn from that, both good and bad. So yeah, education and just get started. You're 20, you've got 50 some odd years to do this. You could accomplish so much, and just that. Don't let your youth hold you back or be your perception. Because I remember when I got started, I would show up for a tour of 100-something unit property, and I guess it was about 30 or so. And sometimes the brokers would look at me and they would make jokes about like, "Are you old enough to be doing this?" Right? And of course, once we kept closing deals, they realized it was just fine. So just be prepared. You may get some of that, and just use it to your advantage. You're starting early. You've got a long runway. You've got energy, time. Just jump in there and get started. That's awesome. So, all right. Oh, hey, and Lehigh says bought hers at 24 years old. So awesome, way to go! The earlier the better. Wish I had started back when you guys did. So, all right, let's pick up. We got a few more questions, and let me see here. Which one do we want to go to? Well, okay, we'll throw this one as just kind of a follow up. This is Lelantos. Says, hello. So I am new here for the channel. Is there any advice for an 18-year-old man in this field? Baby step advice, please. Virtual hug. Thanks for the virtual hug. Appreciate it. Really very similar to what we just said. You're just 2 years further. You get 2 years more, 2 years ahead of the last person we were just talking to. A great way to get started is the house hacking. Get started, dive into bigger pockets. This community here is amazing. If you get into the forums, post a question, and the level of activity and response is phenomenal. There's so many people here who are willing to share part of this community. So, all right. Well, we've been going for a while here, and I think we'll go ahead and get it wrapped up. Appreciate everybody jumping on. I love interacting with all you guys. And of course, I'm originally from New England. When I say all you guys, that means both you guys and ladies. So again, thanks for the questions. Thanks for jumping on and sharing. And look forward to talking to you guys further. We'll be doing this probably again here in about 2 weeks. So if you didn't get your question in, or you had to leave, or just showed up, we'll be back in again about 2 weeks. Remember to like, share. If you want to talk any further with me or connect with me offline, of course, I am on Bigger Pockets. There's LinkedIn. Best way to have a real conversation is just Google Vantage Point Acquisitions. VPACQ.com is the actual website. There's a little contact us form on there that comes to my email, and hopefully we can connect that way. So hope you are healthy and safe. Hope your investments are doing well. It is a bit of an uncertain time, but that usually means opportunities are coming. So go out there, get educated, get prepared, get ready to start doing some awesome deals. Lots of real estate wealth is going to be created in the next few years, and make sure you're part of it. So look forward to talking to you again. Have a great weekend. Take care.